Hey guys, in this video, I just want to do a bit of a portfolio update with my Wealthsimple portfolio. We'll go through my positions, my Canadian positions, my US positions in this video, talk about where I am on each of my positions, why I like it, why I hold it, what I'm thinking of doing with it, what positions I'm looking at buying more of, what positions I'm not, etc. So this will be a pretty long video, but if you like this type of content, please hit the thumbs up button, subscribe to the channel. Would love to hear from you in the comments as well. If there's any stocks here that you own or that you're looking at buying, I am not a financial advisor. This is just for entertainment purposes. But would love to have any spirited conversations if you guys disagree with any of my perspectives or have your own opinions, because I definitely learn a lot from you guys in the comments as well. Okay, so we're going to go into my portfolio here. Overall, it's about $176,000 in my Wealthsimple portfolio. About two-thirds of that is in the Canadian side. Before getting into the stocks, I am down 5% in the last month with everything that's been going on. I have a lot or some banking exposure in the Canadian banks, as well as some real estate exposure, which has been getting crunched a bit here. So I'll give my perspective on that. Over the last year, still down a couple percent. And then overall, I opened this account, I believe in late 2020, let's call it, yeah, October 2020. I'm up about 4% over the last 2 years or so. So, not great, but the market hasn't been doing that well over this time period. So I'm fine with it. Going into my stock. So the first stock I hold here in this portfolio, I think it's done alphabetically, so don't look at the order too much, is Allied Property REIT. So Allied is primarily an office REIT that operates in big cities. They own very flagship type-esque properties in Toronto, Vancouver, Montreal, etc. Lots of their properties are worth hundreds of millions of dollars. So not like side of the road offices and random secondary and tertiary cities. They own some really prominent office space. Also own a couple, I believe, data center type properties for big data companies in Toronto, and own a couple percent of their business in parking that will eventually get turned into multi-use properties. And then I believe 10% of their business is retail, just on the bottom floor of their office properties, typically, given how good the space is. Now, this stock's been one of my worst performing stocks over the last couple of years. Obviously, throughout COVID, the sentiment around office space and the value of it has gone down pretty dramatically. I think, given the type of properties that the stock owns, or holds, rather, it's a bit overblown. The company's been doing just over $2 of funds from operations a share for the last 3 or 4 years. So they're actually making the same amount of money, give or take, as they were pre-COVID. It's just pre-COVID, they were trading at about 25 times earnings. Now they're trading at about 12 to 13 times. So it's gotten about a 50% haircut if we want to look at it from the peak around $50, now about $25. So I think, yeah, am I as bullish, or do I think office space isn't as good of a spot as it was 4 years ago? No. Is there some downside to the funds from operation? Potentially, even though they are building new properties and stuff like that and expanding in multi-use. So there's also some upside in funds from operation. But generally, I think a 50% hit, given the type of properties and where they have them, are too much. 7% plus yield on the stock. It's more than covered. And they just actually opened up a share buyback program for 5 to 10% of the company. So I think long term, this stock has the potential to regain lots of what it's lost. In the meantime, I'll take the 7% yield. Obviously, it's a position in a portfolio. It's not the only stock I hold. It's not even a very large part of my overall portfolio, but one that I definitely wanted to call out. Going on, A&W. A&W is another one that I've actually been adding a bit more to lately. A&W is a restaurant franchise, and this is just a revenue royalty income fund that gets paid out, like, I believe, 3 or 4% of net total revenues from each franchise to the owner of the trademark, which is this business here. And overall, down about 4 to 5%, about 400 shares here. So pretty decent position within my Wealthsimple portfolio. If we just look at this one over the last 5 years, it's making more money than it ever has. Very similar story, or even more so than Allied, but it is actually down from 40, 43, $44. It just hit $40 again last year, down about 15-20% from there. So my average price is about 36.50, and I don't want a Canadian royalty food company to be like a top position of mine, but I don't mind slowly averaging down and getting my weighted average cost lower. This company's increased their dividend for a number of years in a row as their same sales grows, same restaurant sales grows, currently paying about 5.5%. So I don't mind a 5.4% starting yield for a company that's been increasing their dividend by 3-4% a year. Stable business, defensible business, being fast food and quick service restaurant, takeout, etc. And this is a Canadian brand, does pretty well in this market. So I think this one isn't a screaming buy, but it's one that I think is a good opportunity for my portfolio to just get more and more monthly cash flow, low inflation risk, because if anything, people will be trading down in names like this. Low operational risk because it's no real expenses. It's just royalties off the top. And that's why I like that name. Going on, and I'm not going to go into every stock like that, but BNS is Bank of Nova Scotia. This is one I added a bit to as the banking crisis in the U.S. has kind of gone over. Very small position for me still, just $1,000 in this portfolio. But this is one that I think with the other Canadian banks that have gotten hit, has very low risk of the same thing happening as what we saw happen in the US. So I'm happy to buy on weakness. These stocks trade at like 8 to 9 times earnings, paying like 5-6% yields. So this one 6.2. So I think that's a really good value equation to own a stock that's been increasing its dividend for 50 years, essentially as part of an oligopoly. Is such a big part of the Canadian economy that if anything ever push came to shove on these names, the country would be there to back them. So I feel pretty confident in buying these stocks under 9 times earnings. I think the combination of buybacks, acquisitions, dividends, I'm going to get a pretty good total shareholder return over the medium term. And then just skipping through a couple of these, Canadian apartment REITs, another REIT hasn't got hit as hard as Allied, but with interest rates going up, that's just been a general headwind for REITs and their cost basis. So this one is trading at about 19 times earnings at $46, which once again used to trade closer to 25 times given the defensive nature of the apartments and the rentals that they own. So similar sentiment to Allied, except probably trading at a much higher valuation still, because they don't have as many operational issues and existential threats in the type of real estate they own, but they do still face the interest rate issue. Cash is just a place where I hold some cash. It is, if you look at like the last year, it's no caveat this, but essentially a no risk investment. It's just holding in cash. You're getting paid just the interest on cash every month. Total right now is about a 5% dividend on an annual basis. So if you have a lot of cash in an account, this is something you may want to look into. I have about $15,000 sitting in this, and I'm probably just doing quick math, making about $750 a year as I keep 15,000 just on the side here as almost just like, I wouldn't call it an emergency fund, but an area of my portfolio that I just have some liquidity in case stuff really hits the fan and I want to buy a big position in a stock or really average down on one of my existing stocks. Canadian National Railway, probably my favorite overall company that I hold. Huge moat, great long-term performance, really steady, increases the dividend every year, buys back shares every year. About $11,000 in this portfolio. over 5 years. It's really steady, compounding 10-15% returns every year, generally speaking. Still trading at a reasonable valuation, hasn't really got hit much with everything else over the last, honestly, even the last year. You can kind of see here, pretty steady despite everything going on. So it hasn't been one I've been adding to a lot lately, just because I feel like there's been better valuations out there. But it's one that I do like to consider continuing to nibble on quarter after quarter to continue building my position for the long term. Canadian Utilities, this stock has actually done pretty well over the last couple months, but this stock has about a 5% yield. Let's go past 3. Okay, it's been flat, which isn't bad given everything else that's happened. But I believe, yeah, 4.8% yield. They increase their dividend every year for the last 40, 50 years, but they're kind of in that period where they're increasing it like a penny a year, like a percent a year, give or take. So you're not going to get great dividend growth here, but something's better than nothing. And with a 4.8% starting yield and primarily regulated revenues, there's not too much that you can complain about there, as long as they continue to operate and slowly grow the company. Div is an interesting company here. We actually just got a pretty big hit the last month, as it looks like BMO's buying their air miles trademark from the holding company that owns the operation. So I don't know what implications that's going to have for Diversified Royalty, who gets paid annually for the use of that trademark. I think that was worth about 10% of their revenues, and the stock's actually down 10%. So I know there's broader macroeconomic things that are taking place, but it'll be interesting to see how that plays out. Their big business, where they get, I believe, half of their royalties from, is the Mr. Lube brand. They get a royalty of 5-6% on every dollar that's spent on that company. And then some other businesses they have exposure to is Oxford Learning Centers. I think it's something like Nurse Next Door. It's like an old age service to send nurses to homes. A company called like Mike's Steakhouse. And then they also just acquired a commercial cleaning company primarily in the US. And they pay them, like, I believe $6 million a year in royalties to use the rights to the franchise in that market. So just as the name says, just a diversified corporation of royalties, but you're primarily investing in Mr. Lube and revenues that are going into Mr. Lube. So just be aware of that if you do consider buying this stock. It's paying me almost an 8% yield, 7.5. On top of that, it's held pretty steady. It did come down 10%, but it really flew up 10% right before that, just based off of broadly strong performance across their other businesses before the air miles thing took place. So it'll be interesting to see how this one develops. I'm enjoying getting my monthly dividend, getting 7.5 points back a year. Not a big position for me overall, about $5,000-$6,000 in this portfolio, but definitely one that gives me a good amount of cash flow. So I like that about that name. Okay, moving on. First Capital REIT. So this is one of many REITs that we'll probably touch on quickly here, that has really gotten hit over the last month, down 15% over the last month. And I think it's a bit undeserving. So REITs are actually one of the areas that I'm looking at adding throughout my portfolio to my existing positions, not new REITs, but I have First Capital. We're going to talk a bit more later, but First Capital reminds me of Allied in a way, because they really focus on premier retail space, really flagship locations, downtown cores, very rich neighborhoods, stuff like that. Very strong tenants, about 70% grocery anchored properties or anchored NOI that's coming into these companies. So really well positioned. And I believe they make about $1.20 a year in FFO. So we're talking 13, 14 times earnings is what they're trading at. I think that's reasonable valuation given the times we're in. They're also buying back a lot of shares and doing a lot of value realization, since their net asset value is, I think, closer to $25. So they're liquidating some non-core properties, buying back shares. That should inherently bump up the unit price over time. So this is one that I don't own a big position here in this portfolio, but I'd be looking to add some more. Fortis, regulated utility company increasing the dividend 5-6% a year, really stable, just a lower current yield, future growth rate version of Canadian Utilities is how I think of it in my mind. It's done well. It's done okay for me, and it's one that I'm not looking to add to right now because I really treat it as like a bond. But as the value goes down, or if the value of it goes down, I'd be open to adding more. Okay, on to some of my covered call ETFs. So HDIF, this is a company that has not been performing great for me since I got it. I only own it in this portfolio, so only about $3,500 to my name. In this, I'm making about 35, $40 a month in dividends, over 10% a year in dividends here. But this one has given up almost 10% value as the market's just fallen and interest rates have gone up. They have 25% leverage. So more interest rates, more borrowing expenses that are taking away from the covered call options. This is one that, with covered calls and stuff, I try not to go too heavy in them, especially when there's leverage involved. I really just wanted some enhanced income. It hasn't worked out for me great so far, down 8%. Probably have gotten, maybe 2-3% back in dividends, but one that, maybe I'll nibble on a bit, but I really don't want to make something like this a big position for me. The next one here is Equal Rate Global Utilities. This is also a covered call ETF. Down just a couple percent on this one. Not leverage involved in this one that I know about, I don't believe. So this one with the dividends I've gotten, I'm actually probably slightly up. And more open to invest in a bit more into ETFs, covered call ETFs that don't have leverage, but still not really looking to make covered call ETFs too big of a portion of my portfolio, just because while they do provide me some income today, they do kind of cap the upside, and I'm still a pretty young investor, so I don't want to go too heavy into those, as nice as the income today is. Keg Royalty Fund, similar to A&W, except this one has not gotten hit very much. I'm actually up on it. So this is one I'm just getting my dividend every month. I have a much bigger position in a couple other accounts, just 50 shares here. So I'm getting like $5 a month in dividends. Not really looking to add to that one. I think there's better opportunities on a valuation perspective. Back to some ETFs, covered call ETF on healthcare, global healthcare, think like Pfizer, big pharma companies, United Health, stuff like that. $7,000, similar to the sentiment on like Huddle or HDIF. Not really looking at making these too much bigger. I just like getting the $50-$60 a month from this one. So unless a big crash happens in healthcare and I think it's overdone and I use this as my play for it, I probably won't go too much heavier into this one naturally. Northwest Healthcare Properties. This is one that I've been meaning to do a lot more research on still. I know some reasons why the stock's been crashing, but I don't get how it's crashed to this extent. I'm sure I'm missing something. I know they're such a complex business now as they roll in a bunch of acquisitions. They do property management, blah, blah, blah. So this one over the last year is down 40%, huge, probably yielding, over 9% now. So I do have a decent size position, not a large position, but a decent size overall, only 4,000 in this account, but I think I have about 1,500 shares, so probably about $14,000. And I really need to look into what's going on here. Not really buying more until I understand it, but it may be a good buying opportunity if I think it's overblown. So one that I definitely need to look into. I'm taking as the next step on that one. Okay, QSR. QSR really ran up. I was buying it earlier in the year, closer to 65-ish, and then it just tore up, had a good earnings report, then announced that Patrick Doyle, who was the Domino's ex-CEO, was being the chairman of the board, jumped another 15% on that. I hate when stocks jump 15% on personnel changes, but it is what it is. Now it seems like it's coming back to life a bit, or reality a bit, almost a 10% drop in the last month. I'll reevaluate this one. If it gets back under 80, I may nibble on it a bit, but not one that I'm really looking at making a huge part of my portfolio. Have a decent position in this Wealthsimple portfolio of it, but it does pay a 3.5% dividend yield. So I am liking getting the dividends as I wait for it to either go up or for value to correct, and maybe I'll buy back if the yield and the PE becomes more enticing. Okay, Rogers. Rogers is one that's waiting on an acquisition. So they're looking to buy Shaw. Um, this one, I think, um, is fairly valued today, over a 3% dividend. I think it'll go up if it acquires Shaw, probably down if it can't. So just waiting for that dynamic to play out in a world where it doesn't acquire Shaw. Maybe I reconsider if I want a bigger position or buying more. But I have a decent sized position in this today, actually smaller than I thought. But just with the acquisition looming over their heads, I'm hesitant to make a big bet here. I just want to see how it plays out first, and then I'll re-evaluate the company after that. Ryokan. So Ryokan is one of my biggest positions in my overall portfolio. Not a huge position here, but it's definitely one that I know very well and have been owning for many, many years. Similar to some of the other REITs, has dropped pretty big in the last month, $20. I believe their net asset value is $25, $26. So this is one that I am open to buying some more of. I want to be careful with how heavy I push my portfolio holistically into Canadian retail space, but I am getting a good dividend every month, over 5%. These are really good assets. They are really good capital allocators. They buy back shares, pay off dividends, increase dividends, buy back debt. So I like their balance sheet. I like their management team. I like their assets. This is one that I'll continue to nibble on, especially if we get back under $20, which we're right there. TD is another big stock of mine, my biggest bank stock that I own in my portfolio, down about 20% in the last, wow, maybe even the last month or so, almost down 20%. Now, out of the Canadian banks, they do have a bit more exposure to what's going on in the US. They own a chunk of Charles Schwab. They also just bought Cowen, which isn't really a bank necessarily. And they do have an offer out to buy First Horizon Bank, which is a regional bank. So we'll see how all of those things play out. In the grand scheme of things, the value of all of that exposure is less than what the company's gone down the last month. And I think their core US and core Canadian banking business is super strong. They're like the fifth biggest bank in North America. I don't think this is going to go under, have a cash call in the same way as some of those regional banks have had. So I think it's a great buying opportunity. Buying TD at a 4.7% yield when they've increased their dividend 30 straight years in a high single digit CAGR. It's a great opportunity to have a long-term yield on cost in excess of 10%. So this is one that I'm actively nibbling on as well. ZDI, this is my international exposure into Europe, with everything happening in Russia, Ukraine, stuff like that. This one really got hit, and I built a bigger position when it was in the 17s, the 16s. Now it's really climbed up over $20 again. So I'm up on this one. It's also paid me about a 4 or 5% dividend over the last year. This is one that, not looking to add to. It's one that I'm just getting my monthly dividend from. And there's other opportunities to invest in international exposure, whether that's through some of these covered call ETFs that I want to be careful on, but even just some of the US companies and more global companies that get me that exposure through other divisions of their operations. That's probably what I'm more focused on than adding to this ETF specifically. Then just finishing up with some Canadian covered call ETFs. So a Canadian bank covered call ETFs. We just went through why the banks got hit. That's really impacted these ETFs as well. But I am getting like a 7.5% dividend here. ZWC is just a high Canadian dividend call ETF, high dividend call covered call ETF. Sorry, and it pays about an 8% dividend too. This one, I'm down about 8%, so hasn't really moved in terms of total value over the last year. These ones, similar sentiment as the other ETFs, I'm trying to be careful with them. So careful in the sense of I don't want too much of my portfolio in those types of assets, but I do appreciate the the cash flow that they do provide. So that's the Canadian side of my portfolio. I'll put a time stop in here. I guess too late now, but for those who just want to jump to the US side, I'd say just to summarize on the Canadian side before moving on. Um, Overall, I think banks and real estate are trading at enticing valuations within the Canadian stock market. And generally, that's where I'm going to focus on adding most to over the next quarter, let's call it. And then as opportune opportunities become available, what in you know revenue royalty funds, whether that's A&W or diversified royalty, as a means to just juice cash flow and diversify my cash flow streams. I'd be interested in adding those if the yields are right, and just the overall investment case is right, in terms of how their business is doing and growing and their forecast relative to their valuation and yield. So that's kind of where I'm focused on the Canadian side. On the US side, so a bit of a turn. Historically, the Canadian side's been doing better than my US portfolio. Now my US portfolio is up 12%, Canadian one's only up 4. Big thing there is obviously the banks and the real estate have dipped pretty heavily on the Canadian side. I don't have that same exposure in my US portfolio. But as I look here, I actually dumped Airbnb when the stock went up to $135 after earnings. And ever since it went back down to about 120, I started nibbling back on a position. Now I'm kind of trading in and out of this one because I love the company, love the business. Just if they're going to do $3 of earnings this year, they're trading at like 40 times. And I think they could do closer to 4, but they're still trading at 30 times then. So when the stock went up to like 140, 135, 140, I thought, even though I love the business, I think it's overvalued. So it wasn't a huge position for me overall. I just dumped it, made 20 or 30%, I think, and had about $8,000 in cash. I've redeployed some of that cash, and we'll talk about where that's gone. Still have a bunch of it available for trading. And when the stock went back down 10, 15%, I thought it would be a good opportunity. Hey, let's buy back in a bit. If it goes back up, I'll sell and make a quick profit. If not, it's a good opportunity to average back in to my Airbnb position at a more reasonable valuation. Google's a big stock of mine throughout some of my other portfolios. In this portfolio, I have about 3,300 US dollars. I think long term, Google's at a good valuation. I know they have headwinds, ChatGPT, yada yada. End of the day, I think they spit out a ton of cash flow. They have a lot of cool technology that's under monetized and a lot of opportunities. Every business has headwinds to a certain extent. They may have not had it in the past and now they have to deal with it, but I think they'll be fine. And I'll just leave that at that. Coca-Cola is a pretty new position for me. I like their reliability, defensiveness, starting dividend of 3%, dividend growth streak over the last 20, 30 years. So this is where lots of my money from my Airbnb sale went into. I'm obviously about flat just because I've just been buying it now. Currently have 60 shares. If the stock trends down much under $60, would love to get that up to 100 shares and then go from there as I kind of become more familiar with the company through future earnings reports. McDonald's is a very expensive company, but once again, a defensive company, so it's got a really strong valuation. Not one that I'm looking to add to, but one that I like to have in the portfolio for sure, just to diversify away from some other types of maybe higher beta, more volatile companies that I have. Meta is one that in this portfolio I'm up 90% on, but to be honest, overall I'm not up quite that much, and I've held this stock for 5 or 6 years in some other portfolios. So this is one that I just think is undervalued when you just take their core business into effect. And there's been lots of drama about Reality Labs, what the company's doing there, how much money they're burning. But I'm believing in the core business and that things will come back to the core business in terms of priorities and capital allocation, and that Reality Labs will get, invested in at an appropriate rate over the long term, as Mark's pet project. But on this one, I think they still have a lot of opportunity to monetize Reels. to monetize WhatsApp. I think they're doing lots of work um, to raise ARPU in emerging markets and whatnot. So I think this, for a company that just reaches like 3 billion consumers a day, their market cap can be significantly higher if they monetize accordingly and roll out new types of products in e-commerce and stuff like that. So pretty big position for me overall, despite not being a big position in this portfolio. So looking forward to see what the future holds for Meta. Microsoft is also a really big position for me in some of my other portfolios. Um, Kind of trading up here with all the chat GBT and AI craze has gone up about 20%. So it's not one that I'm actively adding to now, but it's one that I love to hold as well. And if they have a really strong earnings report, or if they do get hit really badly and I don't think it's justified, it's one that I'd love to buy more of, still under 300. P&G, similar to McDonald's, Coca-Cola, relatively defensive, safe company, dividend growth companies over time. So not really looking to buy a ton more, but I like having them. AT&T. AT&T is a stock that I've actually started buying a bit more of recently. They've had some pretty good momentum on their last couple of earnings calls, after getting rid of Warner Brothers. They seem a lot more focused. They're delivering on wireless, but their stock is not trading like they are. Over 6% dividend yield. They're going to do $2.50 of EPS this year. So they're literally trading at 7 times earnings. And I think, the ability to trade at 7 times earnings means that their market cap is 130. So they're going to be making like $16-17 billion of cash that they can give back. They're probably going to give 7-8 billion of that in dividends based off of 6% of their market cap. Then they're going to have another $8-9 billion to do debt repayment, and if not buybacks, if not investing in new revenue growth opportunities. So I know this is a bit of a boring and aging segment, but like I think 7 times earnings is too cheap for a national provider of, albeit cable, also wireless and other businesses that are growing and that are essentially a staple for consumers to have access to data and communicative services. So I think this is one that is just undervalued, and once again, not one that I think their core operation is overly strongly positioned for secular growth or anything like that. But 6% starting yield with a lot of free cash flow on top of that to grow and defend the business. I don't mind owning that at all. And then Visa. Visa is one that I would love to buy more of. I'm waiting for it to go down closer to 200 if possible. I like those valuations a lot better. But I think this is a great business. It's essentially a royalty on the global economy, of royalty on travel, as they make more money when people are traveling and they get the FX fees and stuff like that. Really well positioned. If there was any scare of, smaller companies, whether it be, PayPal, SoFi, those kinds of companies coming in, Square or Block, infringing on their space in a huge way really quickly, I think the market's kind of traded all of those things down. Afterpay, buy now, pay later has kind of gotten destroyed. Affirm, so I think from a competitive market lens, it's those things still exist and they have to be cognizant of it, but it's really back to like Visa, MasterCard, and all of the headwinds of people, stealing pennies from them here and there are minuscule relative to the global opportunity they have of moving people from cash to card payments, as well as other opportunities to use their network, peer-to-peer, etc. Tons of opportunities. I've done whole videos on Visa. So I think it's a great opportunity, great stock. One that I still think you could buy here and be okay long term, but trades at a pretty expensive PE. So I'd rather get in a bit lower to minimize the risk reward on this name. So I hope you guys like that portfolio update. Just going through talking about how I feel about my positions in this portfolio, what you can expect from me in the weeks and months ahead in terms of where I'm focusing my spend on and investments and what I'm just kind of riding out, collecting the dividends. Overall, I'm pretty happy with how the portfolio is done. I don't really measure myself on unrealized returns. Most of these stocks I hold for very long periods of time. Kind of caught me on Airbnb trading a bit, but generally I've held lots of these stocks for 5+ years. And I really focus on cash flow, how much dividends I'm getting on an annual basis, more so than trying to make 40% quickly on a stock and dumping it. I only do that in cases like Airbnb where I love the company, think it's overvalued, so I'm like nibbling in. But if the stock goes up further, I don't really want to build a big position at that high valuation, so I'll just take my profit. But generally, these are buy and hold investments, take the dividends, reinvest them, build my pool of dividends over time. And I hope that comes across in these videos as I talk out kind of buying dips in certain segments that I think are undervalued. If you like this type of content, please give it a thumbs up. Would love for you guys to subscribe to the video for more. Let me know in the comments what type of videos you guys like or what type of stocks you'd like me to talk about. Would love to engage with you guys more. And thank you guys for stopping by, and I'll see you in the next one.